This video is brought to you by the award-winning prop firm, Fidelcrest. All right, traders, we've got Erik Smolinski in the house here. We've just done an awesome podcast. You've got to go and check it out. There's so much gold in there. There's a link underneath this video, but what he's going to do is break down some of his own trading, what he does, and part of it is to do with what is in Alexander Elder's book, Come Into My Trading Room. I think that's the book, isn't it? Cool. Well, look, let's open your price chart and have a look at how this works. Fidelcrest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets Fidelcrest apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
The thing I really like about Alexander Elder's work is he encourages people to use different time frames. And I think that's probably a less common approach to people. Traders tend to get hyper-focused, especially if you're a short-term trader. Talking them into looking at longer than a 2-day chart is like pulling teeth because they think there's nothing out there that interests them. But realistically, I think from a contextual standpoint, it's super useful. So what Alexander Elder talks about in his triple screen is you kind of have your intermediate level, and that's whatever your preference is. So if you're a day trader trading 2-minute candles, cool. That's your intermediate level. And then you kind of have this higher level, which is one click up, typically 5 times on the candles, and then one click in, which is essentially just cutting it by 5. So you have a chance to take a view at some different things, and I think it's super useful. So what I want to walk through people through right now is a recent example on how I use that general methodology along with a handful of other of my favorite indicators to create one of my more profitable trades so far this year in SPX. You could do this kind of thing really in index futures. It's not, specific to an individual product. I will say one of the downsides, though, when we look at stuff like this, trading things like SPX, you don't get volume because it's cash settled. There's no volume to be here. So it's very difficult to get a sense of some of the magnitude of things. You miss that. So sometimes in the middle of this, you're actually going to see me switch between SPX and SPY. You could do SPX and the E-minis. I'm just wanting to get some volume out here so that I have an idea of different magnitudes, but we'll start over here on SPX. Now, another quick note is this was obviously, I'm going to share a good trade, not a bad one. And this was just a bearish play in SPX, but this is all armchair quarterbacking. I already know what happened. The trade already went up and has come down. So I want to be very clear about my thought process, though, during the trade, because that's what matters to people most, not how I can look back at a chart and find something that works. Everybody can do that. So all that preamble out of the way. The strategy we're going to be talking about is an option strategy. Not going to go into detail on the strategy. I want to focus on just how I'm applying technical analysis to serve that strategy. And overall, if I look at my portfolio, I have a lot of long deltas. It means I have a bullish disposition in my portfolio. That means I have risk to the downside, and I want to make sure I have some risk covered, not necessarily for a hedge, but to take advantage of a pullback movement. So I'm starting here with a 6-month daily. Sometimes if you're unfamiliar with the product, it can be useful to come all the way out to a year. Notice how things start to look very different already. I'm going to identify what's on this chart for you. It might look kind of noisy, but there's only a handful of things. We have linear regression channels here in the background, and you'll notice that there's kind of 2 brackets. We have linear regression channels 50 and 100. Great question, Cam. What is the difference between 50 and 100? Essentially, it breaks down the size of the moves. So linear regression channel 100 is going to take 100% of the largest move from this line of best fit. This is the statistical component. And essentially, it's going to plot these channels. And then a linear regression channel 50 takes, you guessed it, 50% of the largest move and plots those inner channels. The reason why I really like linear regression channels compared to something like standard deviation channels is we know that markets are very taily. They have fat tails. It means that uncommon outcomes happen more frequently than we think they should. So if you use something like just pure standard deviation channels, it doesn't help us take that into account. So linear regression channels, I like to liken them to kind of using an exponential moving average versus a simple moving average. Gives you a little more weight to the data as it is right now. Now, the way I like to use linear regression channels is one, broad trend identification. One of the easiest ways you can do it is just use whatever the line of best fit, the linear regression line itself. This tells me, okay, on a 1 year daily, we're very clearly downward sloping. This will change as you change to different time frames. And this is why it gets really important to look at multiple time frames to find a hypothesis that aligns with the time frame that you're trading. Because if we zoom this in now to a 6 month, now it's completely flipped. So you might have a short-term bullish trade hypothesis that could fit beautifully within this shorter-term window. And this is one of the important parts about using multiple timeframes. The other things that you see on the chart, all these squiggly lines, those are just moving averages. That's it. There's nothing crazy about them. I do like to use VWAP moving averages when I can. So it means volume weighted average price moving averages as compared to just price that's based on what's moved during the day in terms of high, low, close. And I have different time frames. So I have a 9, a 21, I have a 50 and a 200. Sometimes this will be a 150, sometimes a 200. I flip back and forth. So let's talk about this recent trade. If we zoom in a little bit more, my typical preferred time frame is going to be either a 30-day 1 hour or a 3-month daily. And that's because a lot of my trades will span about 2 weeks. So I like to give enough room to see the overall trend within my time windows. So if we come out here to a 3-month daily, we saw a just near parabolic rise in SPX. And I beta weight my deltas, so to the SP 500. So I can use something like this to offset some of the risk, but more importantly, take advantage of an opportunity while offsetting risk in the portfolio. It's my favorite setup. And in this scenario, we essentially had near 9% move over the course of 2 months. So I 100% felt like we were starting to get very toppy. If we look at the quality of this rise from the beginning of the year, this is steep, very steep, relatively to what you'll see in other timeframes. So if we back out, you can see how steep this is compared to something like this, with a little more gradient to it and consolidation periods. Why does that matter to me? It matters because I start to think, very steep, disorganized rally, but unidirectional, meaning we're going kind of one way with big candles. I start to think pullback. Does it mean pullback? Sure doesn't. Start to think pullback. As we started to hit up along this 4,200, I got very curious. And this is when I'm going to introduce one other tool to you very quickly, which is volume profile. I really like volume profiles, and they tie to different time frames, but I can use volume profiles to find where I'm going to see support or resistance. Specifically in this case, I wanted to see when we're going to see a bunch of supply next. And to no surprise, if you look out on a 1 year daily, there's a volume node right here, and then I kind of extended it out so that you could see where it would fall inside the chart. But this is where there's essentially the third largest volume node. The reason, again, why multiple timeframes are so important is because if you look on a short-term time frame, it's definitely down here and then down here. So you miss some of that broader context. And it's why using multiple timeframes is so important to at least my process, is because even though you might have a short-term time frame, it doesn't mean everybody else does. So you're also competing with people who have a bunch of supply here and they're ready to get out of their trade against a broader declining market. So just because they're not intraday trading like we might be, they still matter. So as we zoom in to the 30-day, kind of my sweet spot, notice a couple things. This is that volume node that I showed you from a longer term time frame, and also notice how big that volume node is here now. It's filled out quite a bit. So I'm first thinking, okay, if we get to this volume node, I'm originally thinking it will serve as resistance as there's supply entering the market, probably push price down. And as you can see, exactly what did not happen. We went straight up through it. It's like, okay, that happens sometimes. That's not where my trade's going to be predicated on. What starts to get really interesting to me is this. We move up to a +2 linear regression channel. that inherently tells me, based on typical reversion to the mean thought process, this is an extended move. Important note, something can go to a +2, -2 linear regression channel and stay there for quite a while, longer than you might think is make sense, but it will at some point retract towards the mean. Markets can remain irrational longer than most traders can remain solvent. So it's a super important thing that if you see this, you don't just start betting the house on a contraction. It can stay there. In this case, I wanted to see how did it behave around this line. As soon as I saw it poke above the linear regression channel +2, and it couldn't get near this 420 node, and we started to fall down, this is where my main bearish thesis started to come into play. So I'm going to zoom us in here a little bit so it's easier to see. So we pop up here. We have 3 candles that can't really make any progress. Then we have 1 candle on better than average volume compared to these 2 previous days. Notice how small the volume is there. We have this 1 outsized day, punch up, straight back down, and then we have a big rejection. To me, on this day, I am now expecting a down move. Does it mean down move is going to happen? No, but I think probabilistically higher outcome. So this is when I start entering with deep in the money long puts in SPX. It's a bearish trade. I want SPX to come down. My puts will expand in value, ergo make money. So as soon as I start to develop the trade hypothesis, as per always, the market immediately shucks me in the other direction because the market has a fantastic approach where it can make everybody wrong at the same time. And I feel it all the time. And that's exactly what happened. So I had this big up move, but it's no problem because my stop, I have a mental stop that I run on these, and I'm just using the high of this other day. Because if we start moving above this high, it inherently tells me that my entire thesis is wrong. Where I'm expecting bearish, it's not bearish. I define this before I enter on this day. And then from here, I'm just waiting to see what kind of move I can get. This is not a trade where I was attempting to extract a certain dollar amount. The risk on this trade is completely controlled by my entry. So the amount of risk that I put into the trade, I can lose that entire bit and it's still less than 5% of the portfolio. I don't want that to happen. I want this to be a higher outcome trade. That's why I place a mental stop here. And then I'm just essentially waiting to see how it behaves within this zone. As soon as we enter this big supply and resistance zone, it's flirting below, above, but I'm noticing an important trend this whole period of time. We're still staying below higher highs. So this tells me that my thesis is continuing to hold true. And until this new trend line is broken, I'm going to stay in the trade because there's no reason. This is all in profit for me. And then we started to get a pretty aggressive move where all of our moving averages dumped. So this is all gravy. It's kind of what I want to see. And now what I start to do is utilize the shorter term moving averages as my stops. I don't like to use the 9-day if I've already gotten a big move. This is when I'll use the 21-day because it's already a multi-day trade. I like to use a slightly longer term moving average to see how far I can let it run. And then this is actually where I ended up getting stopped out right here. So there's a couple things that I want to highlight from the trade. The first one is I caught a really effective move, essentially from it wasn't 418. I didn't top tick it. It was like 415. And I got stopped out at 401. So it was an 18-point move. And on long puts, that gives me pretty good leverage. The way that this entire trade was predicated was using linear regression channels to identify an extreme move and then simply fading an extreme move. Then from there, I'm using moving averages as general confirmation for my hypothesis. This actually was a very tricky trade for me because the longer term moving average was still upward sloping this whole time. And I don't typically like to get bearish there. However, I knew this was a shorter term play, so I was favoring these 3 moving averages, meaning the 50 is my long term. And then from there, I just use a 21-day moving average as my guidepost. And then the stop is the high of the move I'm attempting to fade. That's really all there is to it. This is more of a directional trade. This lasted a few days for me, well, several days. But I find breaking things down into the more simplistic fashion, looking at the behavior of moving averages, looking at volume to determine strength of moves, and then using linear regression channels to help me understand the magnitude of a move against those other three gives me a pretty effective way to trade directionally when I want. Very difficult in the current markets because there is a lot of chop, but still entirely doable.
All right, folks, I'm here at Black Bull Markets headquarters in Auckland, New Zealand. You can see this amazing view behind me of Auckland Harbour. Now, talking about views, if you do want to get free TradingView Pro, then all you need to do is trade one lot a month at Black Bull Markets, and they're going to give you free TradingView Pro. So, folks, to find out more, click the link in the description below or the card above.
What a great breakdown there, Eric. That was fantastic. I learned about 20 things in there, and I'm sure people can go back. Actually, you were going to talk to us about the IRV as well?
Yeah, I would love to. Can I show you that real quick?
Yeah, let's jump back in and have a look at this.
Perfect. Thank you. I didn't want to run too long, but this is for my options people. So this down here is an important tool. This is a plot for IV and HV. For those that don't know, IV is implied volatility. It's a forward-looking volatility projection. It is essentially what prices options. Very important. Then we have historic volatility, exactly what it sounds like. It's what happened. It's the realized volatility. And for those that don't know, volatility is just a fancy word for variance. How much does something move? When we have higher volatility, we expect things to move more, higher variance. And when things have a lower volatility, we expect them to move less. One of the hallmarks of options trading, and for any options trader out there, a tool in your toolkit, and I very speak prescriptively like this, but I genuinely believe this, a tool in every options trader toolkit should be tied to understanding the relationships between implied and historic volatility. The reason why this is so important is because if you look to buy or sell options, this relationship matters to you. Because if you trade options, you know that it's not just about direction. We have other things to contest with. We need to be correct in magnitude in a certain amount of time. And there's also volatility that interjects. So this is a very easy way to significantly step up your game when it comes to understanding the pricing of options. So here's what I'm showing you. This kind of yellow line is the 30-day implied volatility. And then this orange line is a 7-day implied volatility. So what I want to see if I'm selling premium, I want to see implied volatility tracking above realized volatility. And I like to tie them time frame to time frame. So this white line is a 30-day historic volatility. And then this gray line is a 7-day historic volatility. So what this tells you is when his IV in this scenario is 21.37. And then if we look down here at HV, it's 12.99. There is a big disparity between his implied forward-looking and realized volatility. That means options are relatively expensive for what's actually happening. That is where any retail trader can attempt to start extracting edge via variance risk premiums. That's exactly what this is, and this is how you quantify it. So for the non-options traders, I appreciate your attention on an entire segment that probably sounded like Spanish to you, but nonetheless, for the options traders, you're welcome because it's super useful.
Brilliant. Well, look, thank you very much, Eric, for coming on the show and sharing with us all this useful information. Now, what's the best way for the traders to get hold of you?
For sure. So I'm on YouTube at ES Invests, and then I'm also on Twitter at ES Invests.
Brilliant. And folks, do remember we did do a podcast before this where you get his full story, which is amazing. You got to go and check it out. There's a link under the video to that and all of Eric's links. So whilst you're down there clicking around, hit subscribe, like, and that notifications bell, and we'll see you in the next video. Tired of missing trades or spending hours at the charts? Introducing my Robot Builders Club. With our platform, you can build bots in minutes, not weeks, without any coding required. Get lifetime access to my video course, VIP community, and over 40 ready-made robots. Works with MT4 or MT5, and as a bonus, you'll get 3 months access to my robot lab, where we build and test bots on live calls every week. Join the hundreds of traders who are trading smarter, not harder. Click the link in the description to learn more, get the free training, and download a free robot.